You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, we are in the heart of the earnings season, and today we are taping Options Playbook Radio on October 27th. The markets are closed. We had a lot of the FANG stocks come in today and talk about earnings overall. A huge part of the S&P 500 index announced earnings today. And I should say not today, but this week overall. We had Netflix that announced at the beginning, or has kicked it all off last week. And then we had Google yesterday that announced earnings. So quite a few stocks have announced earnings. Apple is expected to announce earnings on Thursday after the close. And the stock that we're going to talk about today is Amazon, that is going to be announcing earnings. Now, the S&P 500 index was actually down 23 points on the day, trading at $4,551.68. And we saw the VIX come up about $1, and it's trading pretty close to the 17 level. But overall, fairly muted as far as volatility is concerned in the marketplace. And it's just nice to be getting through October, moving on to November, heading into the holiday season. And we're going to try a speculative trade today on Amazon. Now, last time that we chatted, we talked about Tesla. We looked at a very simple butterfly in Tesla, and Tesla made a very strong move. Now, oddly enough, the way that the trade worked out, Tesla announced on the 19th after the close, which is a Tuesday, and we ended up doing the 22nd expiration, which was that Friday. So you had all day Wednesday, all day Thursday, all day Friday for Tesla to trade. And actually, after the earnings, the stock was fairly muted. It opened up, and the market was not very volatile overall, but it did close higher on the day. But then it proceeded going into the weekend very strong. And on Friday, the 29th, it closed about 28 points higher, right around that 900 level, which is right where they were for an all-time high. So it struggled with that area, but it closed very close to it. And then on Monday, the stock ripped through it. We looked at a 950, 970, 990 butterfly, and we would have had some implied volatility come out after earnings, but that trade at any point in time was profitable, but not over the top profitable. And the later you went on in the week, you were dealing with factors like time decay. So it was a very interesting trade to watch overall. There are times when the butterfly was profitable, but then you had time decay eating away, you had implied volatility eating away, and we never did get to our first strike, which was the 950 strike overall. So depending on when you would have decided to pull the trigger and get out of the trade would have really mattered if you would have been profitable on the trade overall. We really didn't pay a ton for that trade. We didn't have a lot of risk. And that's usually the case when implied volatilities are high. And you're putting on butterflies, they will make them cheaper. Now, if you're correct on your forecast and the stock goes within your strike range, you want implied volatility to come in. When we looked at the Tesla trade, we only paid 35 cents for a 1x2x1 butterfly. We looked at buying the 950, selling two of the 970s, and buying the 990. So you had $35 at risk if you just did one contract. If you could have doubled that, which was feasible at one point in time, and you could have sold it for 70 cents, yeah, why not get out of that trade? And we talked a little bit about that on the show. Even though we were 20 points wide, we said, you should never expect to get that. It's not a trade. It's not this butterfly isn't a trade where you're looking for the home run. If you could double or even triple the money that you put into it, you would get out fairly quickly, especially after you had a muted move the day after earnings. So I would have probably looked to get out of the trade on Thursday. I rode it all the way till Friday overall. One of the things that did happen, though, is that we did start approaching that all-time high in Tesla, which we said was possible overall. And then we broke through it. And right now, as usual, when you're looking at options, or I shouldn't say as usual, but frustratingly, the stock flew through our strike prices on Monday, but our option trade had already gone away. The options had expired. And right now we see Tesla trading at 1,037.86. So on paper, it was a real interesting trade to watch. And we're going to do a little bit of a rinse and repeat. Now, one of the things about Tesla, when we did the trade, Tesla had a few more days to expiration. Today, we're going to look at Amazon, and Amazon seems to always announce on a Thursday. That means that in the weekly options, you're going to have a Friday weekly option contract that is going to go away. You got all this premium from Amazon being a $3,392 stock. And then the earnings, we got an implied volatility right around 62% for the most near-term at-the-money option contract overall. Amazon is looking for about just under a 4% move, 3.7% to be more accurate, or a 126-point move approximately. And that's the expected move. I'm getting that number from just looking at buying the most at-the-money call and buying the most at-the-money put on the shortest expiration, which would be on October 29th overall. So because of Amazon announcing earnings on Thursday and these option contracts having 1 day to live, I would have a different approach on Amazon. And I'm actually going to look at a ratio butterfly. Inside the options playbook, we don't actually have just a ratio butterfly. We have something that's similar. We call it a Christmas tree butterfly. But in our instance, we're going to try to get it done for a net credit to the account. So we're going to modify the Christmas tree call butterfly. We're going to be bullish on Amazon in general. So far, the FANG stocks overall have done pretty well during this earning. They were pretty beaten up. Well, I wouldn't say beaten up. They were definitely down in September and October. The NASDAQ struggled a little bit overall. A lot of the tech companies did. Now they have a little bit of momentum. In general, we saw the S&P 500 index actually set a new high. NASDAQ was very close. I think it actually set a new high for a minute or two. And now we are back down a little bit today, but we do still have the markets just overall just doing fairly well this earnings season, just in general. So we had the NASDAQ was actually finished up flat today. And a lot of that probably had to do with Google having a good day overall, and a few of the other companies, tech companies in that area, doing very well too, just after their earnings report. All right, I'm rattling on. So let's go in and look at what trade we would do in Amazon. So once again, I'm going to emphasize nothing's meant to be a recommendation. This is just a paper trade. We are taping the show. The market is closed on the 27th. If I was going to do an earnings play, I would do it a little closer to the close tomorrow, but we taped the show on Wednesday, and they're going to be announcing after the close on Thursday. So if I were to do this trade, I'm totally speculating on earnings. So I would like to be closer to the close on Thursday before I actually set up the trade. But we're going to use the fact that the expected move is 126 points. If we add that to Amazon's stock price, we come up with a total of $3,516 on the call side. Now, the expected move has no regard to direction. They're just saying that this is basically the line in the sand. If somebody's willing to buy a long straddle, the most at the money one on the shortest term expiration, they're willing to buy that call and they're willing to buy that put. This is the price where they're willing to pay for it. Basically, the people that are buying it are saying that they think it will go larger. It'll make a bigger move than the 126 points that you have to pay for it. And the people that are selling it are saying they think that it will have a smaller move. So it's the line in the sand. That's where the expected move comes from overall on earnings. And it's not that big of a move overall. A lot of times you'll see Amazon look at about a 4.5% move. Right now we're at 3.7% as of today with the market close. Is if we take the actual expected move and divide it by the stock price, that's how we come up with 3.7%. And you'll hear a lot of people say that is the anticipated move of Amazon around earnings, or after earnings, I should say. Now, that always has a little bit of a fudge to it because it really depends on the expiration. That's the expected move by the end of the options expiration. But in this instance, it's only going to be one day. Okay, so we're going to go further out of the money because we're going to add a little bit of risk to this trade. And we're going to be doing a 1 by 3 by 2. All butterflies are ratios in general. But I guess I'd title this a ratio butterfly mainly because it's going to be an odd ratio. We're going to do this butterfly. It's going to be a 1 by 3 by 2. And we're going to keep the strike prices the same width. So we're going to look at the October 29th expiration, and we're going to go all the way up to the 3600 strike call. Now, I'm doing the 3600 strike call mainly because it's easy to talk about, nice round numbers overall, but that is approximately 85 points higher than what the expected move is at. So the expected move would get the stock to about 3,516. We're going to look at the 3,600, and we're going to try to get this done for a net credit to the account. So in this instance, we'll be buying the 3,600 strike call, selling 3 of the 3,620 strike calls, and buying 2 of the 3,640 strike calls. So it's the width between the short spread and the long spread on this butterfly is 20 points, but we're going to be selling 1 extra short spread, and we're going to use that proceeds to try to pay for the long spread overall. And that's the concept of doing this ratio or modified, or the closest thing, I guess, would be a Christmas tree butterfly, but a Christmas tree butterfly usually isn't done for a net credit to the account. Okay, so if we look at these prices and we put this ratio on, we can get this done for a net credit of $1 to the account. Our maximum risk on that trade is going to be $2,000. So on a percentage basis, that's not great, but the stock's got to go all the way up to 36.40 by that expiration date and be beyond that for us to lose that maximum of $2,000. Could Amazon do that? Yeah, it's possible. It's feasible for that type of trade to happen. Now, if I put this trade on and the market opened anywhere close to the 3,600 strike call, which would be basically a 200-point move gap open on Amazon. If that did happen, I'd want to get out of the trade fairly quick because I have additional risk on this trade. Now, ideally, what we would like it to do is to open up about the expected move and drift towards the strikes in our butterfly. And hopefully, even though we did this for a net credit of $1 to the account, hopefully we would land somewhere between the 3,600 strike call and the 3,620 strike call. There's a 20-point range that we'd really like this to land in. Now, if it goes a little bit beyond that, that's okay. We can still be profitable on the trade, but we really don't want it to go all the way above the 3,640 strike call. So this is a little different, modified butterfly, if you will. We're going out more than the expected move. We're trying to do it for a net credit to the account. If the market goes down after earnings, which is very feasible in Amazon, well, we can make that net credit. We'd make that $1 for every 1 by 3 by 2 that we did. All the options would just expire worthless, and we would keep that credit. We would know fairly quickly if that were to happen overall. Our nervousness is just on Amazon blowing out the numbers and going above and beyond the long call that we're buying as protection. So in summary, it is Wednesday, October 27th. Amazon closed at 3,392.49. They will be announcing earnings tomorrow on the 28th. We're going to be buying the October 29th expiration. We're going to start by buying the 3,600 strike call, selling 3 of the 3,620 strike call, and buying 2 of the 3,640 strike call. The midpoint, with the market's closed right now, is $1.08 to the account. And if we put the trade on after their earnings, we're going to watch really closely. We really don't want this market to go against us beyond the 3,620 level. We definitely want to close it out no matter what. We will have additional margin of $2,000 to put this trade on. $2,000, you can say minus the 108 because we can use that credit to help pay for our margin requirement on the trade. And we'll see what happens. It's always fun to do a paper trade in Amazon around their earnings because of the dynamics of the pricing mechanisms now that we've had, and for a long time that we've had, weekly option contracts. So that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. I also want to let you know that on November 3rd, we're going to be having a large digital conference on the Ally YouTube channel. If you'd like some more information on that, please email me. I'll be happy to send you the registration page overall, or you can always just follow me on Twitter. I will be tweeting about that event and all the events within Ally. My handle is @BrianOverby. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.